What was the Black Monday 1987 stock market crash? Imagine waking up one morning to find that the value of stocks you own has suddenly dropped by more than 20% in a single day. That's what happened on October 19, 1987, a day that became known as Black Monday. On that day, stock markets all over the world experienced a huge and unexpected decline. The United States stock market, specifically the Dow Jones Industrial Average, fell by 22.6%. This was the largest one-day percentage drop in history. The total losses worldwide were estimated to be about $1,710 billion. This sudden crash made many people worry about a repeat of the Great Depression, which was a severe economic downturn in the 1930s. Leading up to Black Monday, the stock market had been doing very well. The Dow Jones had increased by about 44% over 7 months. Many investors thought the market was overvalued and overdue for a correction. In the weeks before the crash, negative news started to spread. The United States had a larger-than-expected trade deficit, meaning it was importing more than it was exporting. The value of the U.S. dollar also started to fall. These factors created a lot of uncertainty and made investors nervous. One of the main reasons the crash happened so quickly was because of new technology called program trading. These were computer systems that could automatically buy or sell large amounts of stocks when certain conditions were met. On Black Monday, these systems caused a chain reaction. When some stocks started to fall, the computers automatically sold more stocks to limit losses. This selling triggered even more automatic sales, speeding up the decline. Another factor was portfolio insurance. This was a strategy used by big investors to protect their investments. When stock prices dropped, they sold futures contracts to hedge their losses. But this strategy made the situation worse. Falling stock prices led to more short selling of futures, which pushed prices down even further. The crash was not limited to the United States. Markets in Asia and New Zealand also saw big drops before U.S. markets opened. For example, New Zealand's stock market fell by 60%. Because markets around the world are connected, panic spread quickly. Investors started selling off stocks everywhere, which made the decline even worse. Despite the huge losses, the overall economy did not collapse. Central banks in the United States, West Germany, and Japan stepped in to help. They provided extra money to banks and financial institutions to stabilize markets. This helped prevent a deeper economic crisis. However, some countries like New Zealand, which did not get as much support, experienced longer-lasting problems. Looking back at this event, Black Monday showed how new trading technologies and strategies could make stock market crashes worse. It also showed how important investor confidence and global connections are in financial markets. After the crash, new rules and regulations were put in place to try to prevent something similar from happening again. Understanding what happened on Black Monday helps us see how modern financial markets work and the risks involved with automated trading and interconnected economies.